Welcome to The Explainer. Today, we're putting a massive, rapidly evolving financial phenomenon right under the microscope. Over the past few years, retail prop trading has absolutely exploded. I mean, it went from this super niche concept into a massive global industry, attracting literally hundreds of thousands of aspiring traders straight to their home offices. But beneath that shiny promise of trading with a firm's capital, there's a really complex, fast-changing ecosystem. So let's peel back the layers.
Okay, let's dive into this, because this quote right here perfectly captures the core tension of the whole industry. Access to capital has never been easier. Access to lasting success has not changed at all. You see, the modern prop firm model has completely democratized the opportunity to trade large accounts. But, as we're going to see today, financial markets, they don't care at all how you got your capital. The fundamental laws of risk management remain just as brutal and unforgiving as they've always been.
So here's our roadmap for today. First, the rise of retail prop. 2, inside the challenge economy. 3, marketing versus trading reality. 4, the psychology of funded trading. And finally, number 5, the future of prop trading. Now, to make sure we're looking at this through a totally objective lens, our entire explainer today is anchored in this really comprehensive, neutral research document. It's the June 2026 white paper by the Elite Solutions Sweden research team called Retail Prop Trading Under the Microscope. This paper is fantastic because it gives us an evidence-based look into the sector, pulling from regulatory docs, market data, and industry reports to separate the actual nuts and bolts of the business from all that marketing hype.
All right, Section 1, the rise of retail prop.
Now, what's really interesting about this slide is how it highlights the massive shift in the industry. Historically, proprietary trading was this highly exclusive thing, hidden away on Wall Street floors where traders were actual employees trading the firm's real balance sheet capital. But today's retail prop firms, they are fundamentally different. So instead of employment, they run on evaluation fees. Instead of real portfolio risk, traders get conditional access managed through these really rigid fixed drawdowns. Honestly, it's using the exact same name, but under the hood, it's a completely different economic engine. Moving on to Section 2, inside the challenge economy. And this brilliantly illustrates the exact pipeline a retail trader goes through. Because the retail model operates differently, it's got its own unique flow. Step 1, the trader pays an upfront evaluation fee. Then, Step 2, they enter a simulated environment bound by some incredibly strict rules. Step 3, they either pass or fail. If you fail, well, you pay for a reset. But if you pass, you move to Step 4, which is receiving that conditional funded status and a profit split. So it's really this hybrid of trading simulation and achievement-based gamification. So the crucial point is understanding what the paper calls the revenue disconnect. While the product is aggressively marketed all over social media as this golden ticket to access large institutional capital, the actual revenue engine for a lot of these firms is built heavily on evaluation fees and challenge resets. Think about it. Thousands of traders enter, paying fees. A small percentage passes, and an even smaller percentage actually sustains profitability. This creates a pretty massive structural tension when it comes to incentive alignment. Like, are the firm and the trader actually aligned in their ultimate goals? It's a huge question. Section 3, marketing versus trading reality. If you spend any time on financial Twitter or Instagram, you are constantly bombarded with screenshots of massive payouts and, flashy supercars. But this is a classic statistical trap called survivorship bias. Because there's no standardized reporting in this industry, the marketing primarily spotlights the highly visible minority of winners, and in doing so, it completely overshadows the silent majority, the thousands of traders who failed their evaluations or just quickly blew up their accounts. As the white paper points out, passing a challenge proves short-term performance, but sustained profitability proves something far harder. Passing an evaluation, well, it really just means your specific strategy happened to align with market volatility during a super tight 2 or 4 week window. But we all know financial markets are incredibly dynamic. Long-term success, that requires the adaptability to survive changing market conditions over time, which is just entirely different from sprinting to hit a short-term profit target. All right, Section 4, psychology of funded trading. The real battleground here isn't just the market itself. It's actually the trader's own mind. And the primary source of that pressure is the maximum drawdown rule. Now, from a firm's perspective, obviously, this is a highly logical protective shield for their capital. Makes total sense. But for the trader, it acts as a massive psychological hurdle. A trading strategy that works perfectly fine in a personal account with wide risk parameters might literally just fall apart when you squeeze it into a firm's really tight drawdown box.
And these strict rules trigger some profound behavioral shifts under pressure. For example, time constraints force traders into subpar setups. Or early success breeds overconfidence, which leads to massive, reckless position sizes. Then there's the fear of losing the account entirely, which makes traders cut their winning trades way too short. And probably worst of all, getting near that drawdown limit often triggers revenge trading. That's when a trader just throws all logic out the window, desperately trying to make back losses before the firm unplugs them. If you take away anything from our explainer today, let it be this. In the funded trading environment, strategy matters for sure, but psychology absolutely decides outcomes. These challenges are not just tests of market knowledge, they are brutal, stress-inducing tests of behavioral consistency under pressure. Because knowing what to do intellectually and actually executing it when you're literally one bad trade away from losing your funded account, those are two completely different things. Discipline under constraint is ultimately what separates the survivors from everyone else. Let's move to and see how this builds into Section 5, the future of prop trading.
So, the industry has kind of survived its Wild West growth phase, and now it's really being forced to mature. We're seeing a huge demand from traders for behind-the-scenes transparency. Plus, there's AI being integrated for automated risk assessment, and we're inevitably looking at industry consolidation, where the weaker business models are just going to get wiped out. With evolving regulatory frameworks starting to catch up, the whole space is definitely shifting away from that flashy supercar marketing toward actual professionalization and reliable infrastructure.
Which leaves us with this final, absolutely critical thought to ponder. As this industry matures, will technology and transparency successfully build a truly sustainable ecosystem for retail traders? Or is the challenge economy simply going to consolidate into a few massive players, leaving the structural realities of the business totally unchanged? Look, the retail prop model has undoubtedly opened doors that were once locked incredibly tight by Wall Street. But it's super clear that true success still demands the exact same discipline it always has. Thank you so much for joining me for this explainer. Keep asking the tough questions, and I'll catch you next time.